When I first started investing, I thought all ETFs were basically the same. But looking at them side by side, I realized the differences were huge, and that changed the way I invest forever. So in this video, I'm lining up a few of the most popular ETFs side by side, looking at performance to find out which ones are truly worth holding long term. What I found is that one of them quietly stands apart from the rest. Quick reminder, I'm not a financial advisor. This video is just for education and sharing my personal perspective. Always do your own research or talk to a licensed professional before making any investment decisions. Before I could make smart choices, I had to truly understand what I was buying. At its core, an ETF is like a basket filled with dozens, sometimes hundreds of stocks. Instead of trying to pick one winner, you're buying the whole basket in a single move. Simple, right? That simplicity is exactly what makes ETFs so valuable. But here's where things got interesting for me. Not all dividend ETFs work the same way. Some focus on fast-growing companies that pay small dividends on the side. Others lean heavily on high-yield stocks that pay pretty good dividends, and then there's the third group. The one that really grabbed my attention, ETFs designed to do both. Give me consistent dividends while steadily building my wealth for long term. That balance became the foundation of my search. I wanted investments that could reward me in the short term but also quietly grow over the long haul. How I evaluate dividend ETFs. As I dug deeper, I knew I couldn't just pick ETFs based on popularity or flashy names. I needed a clear framework, real criteria that actually matter for long-term results. It's not just about share price performance. What really drives long-term results is total return, which combines price growth with dividends. When dividends are reinvested, that compounding effect becomes a major force. Firstly, I consider dividend yield. Yield shows how much income I can expect for every dollar invested. But I quickly learned that a high yield isn't always good. Sometimes it's a warning sign that the underlying companies are struggling. Then I examined the dividend growth. I wasn't just looking for payouts today. I wanted ETFs filled with companies that grow their dividends year after year. That growth helps offset inflation and usually signals financial strength. Then the most important criteria are risk and volatility. I needed to know how each ETF behaved during tough times. A smoother ride helps me stick with my plan without panicking when the market gets rocky. Then the expense ratio, fees matter. Even small differences can quietly eat away at long-term returns. Over decades, lower costs actually add up to real money. Another important criterion for me is the quality of the companies inside each ETF. At the end of the day, an ETF is only as strong as the businesses inside it. I wanted solid, well-managed companies with long-term potential, not high-risk positions. This framework gave me the clarity I needed. Instead of chasing hype, I could finally focus on what actually mattered for my goals: steady income, sustainable growth, and peace of mind. Here is my first ETF pick for long-term wealth and sustainable growth. DGRO, the iShares Core Dividend Growth ETF. DGRO instantly stood out to me because it matched the way I think about investing long-term. Rather than chasing the biggest yields, DGRO emphasizes something I value more: quality and sustainability. What really impressed me was its screening process. This ETF doesn't just grab companies paying dividends right now. It specifically seeks out businesses with the financial strength and discipline to grow those payments year after year. That growth focus matters because it helps protect purchasing power over decades, even against inflation. Another thing that got me hooked was DGRO's diversification. Instead of clustering in high-yield sectors like utilities, it spreads across technology, healthcare, financial services, consumer goods, and more. That balance reduces the risk of one sector dragging everything down. When I looked deeper, I discovered many of DGRO's holdings. These were household name companies with strong brands, consistent profits, and long histories of rewarding shareholders. To me, that signaled reliability, not speculation. Top holdings: Microsoft Corporation, JP Morgan Chase, ExxonMobil Corporation, Johnson & Johnson, Broadcom. The performance track record also gave me confidence. Over different time periods, DGRO has delivered a mix of capital appreciation and growing dividend income. Together, that created the feeling of a wealth-building engine designed to work steadily over time. On top of that, the expense ratio is refreshingly low, and with billions in assets under management, DGRO offers the liquidity and stability I'd want in a core holding of my portfolio. The next ETF is one of my favorites picks for long-term wealth and sustainable growth: the Invesco QQQ Trust ETF. Unlike more balanced or dividend-focused ETFs, QQQ represents a very different investment philosophy. It tracks the NASDAQ 100 index, which means it's concentrated in some of the largest non-financial companies listed on the NASDAQ. In practice, that translates to significant exposure to technology and growth-driven businesses, the very companies that have powered much of the stock market's performance over the last few decades. When I first looked through QQQ's holdings, it felt like reading a list of the innovators that have reshaped our modern lives. From chipmakers to cloud giants to e-commerce platforms, QQQ is essentially a portfolio of companies defining the digital economy and pushing technological progress forward. For someone like me who values innovation, that makes QQQ an exciting way to participate directly in the industries shaping the future. The ETF performance history speaks for itself. Over multiple time horizons, QQQ has delivered good returns, often outpacing broader market indices by a wide margin, particularly during periods when growth stocks are in favor. Of course, there are trade-offs. QQ isn't built for income. Its dividend yield is modest because many of its companies reinvest heavily into research, development, and expansion, rather than paying large dividends. This makes QQQ more of a capital appreciation play than a source of steady cash flow. Then there's the concentration risk. With such a heavy tilt toward technology, QQQ's performance can swing sharply depending on market sentiment. In times when growth stocks face headwinds or when value investing comes back into style, QQQ can be more volatile than diversified funds. But that's not the end of the story. The next ETF is one of my top choices for building long-term wealth with a focus on stability and income. The iShares Core High Dividend ETF, HDV, takes a unique path compared to many growth-oriented funds. Instead of chasing rapid appreciation, HDV is designed around generating long-term consistent income. It invests in U.S. companies with above-average dividend payouts, prioritizing immediate cash flow rather than long-term capital growth. What stood out to me is how HDV selects its holdings. The ETF screens for companies with strong fundamentals and a proven ability to sustain dividends, even during economic downturns. In other words, it's not just about chasing high yields, it's about making sure those payouts are reliable. Because of this approach, HDV leans heavily towards sectors known for stability and dependable cash flows, such as utilities, energy, telecommunications, and consumer staples. These industries may not always deliver explosive growth, but their business models are often built around consistency, making them reliable sources of dividends. Personally, I saw HDV as a straightforward way to generate long-term income from my portfolio. The sweet dividend yield meant more income flows in for me, which is particularly useful for retirement planning or simply as a cushion for supplemental income. What impressed me most was the sustainability of HDV's payouts. By investing in financially solid companies with steady cash flows, HDV aims to keep dividends flowing even when markets get rough. For me, that reliability is what makes it such an attractive long-term option. It's less about chasing the highest possible returns and more about peace of mind through consistent income. My personal analysis and comparison. After taking the time to research each ETF individually, I started comparing them side by side using my own criteria. That comparison helped me see not just the numbers, but the unique strengths and trade-offs that each fund brings to the table. It became clear that no single ETF is perfect. It's really about which one aligns best with specific financial goals. When it came to total return potential, QQQ immediately stood out. Its focus on fast-growing, innovative companies has historically delivered impressive wealth creation, especially during tech-driven bull markets. But that same concentration also meant higher volatility. To hold QQQ long-term, you'd need the discipline to stomach sharp downturns without panicking. DGRO struck a balance. It combined steady capital appreciation with the power of dividend growth. While it might not deliver QQQ's explosive peaks during tech rallies, it offered more consistent returns and less turbulence. The dividend growth component also added a compounding effect that became increasingly valuable over time. HDV leaned heavily toward income. Its strategy prioritized current dividend yield over growth, meaning total returns might lag during strong bull markets. But in periods of market stress, its defensive nature could help soften the blow. Looking at dividend income, the contrast was clear. HDV offered the most immediate income. DGRO focused more on growth, which could lead to stronger dividend payouts in the long run. QQQ, as expected, provided little in this area since its companies often reinvest profits back into growth. The risk profiles also told different stories. QQ carried the most volatility due to its tech-heavy concentration. HDV, while less volatile overall, was sensitive to interest rate changes because of its sector focus. DGRO, with its diversified and quality-driven approach, offered the best balanced risk profile. The personal decision that changed my strategy. After months of digging into the details, I realized the real question wasn't which ETF is the best, but rather which ETF is best for me right now. My decision ultimately came down to matching my investment with my personal goals, timeline, and tolerance for risk. Each of these ETFs plays a different role. For some investors, QQQ might be the engine of long-term growth. For others, HDV could provide the income stability they need. And DGRO, with its balanced approach, could be the middle ground that fits a wide range of situations. What shifted my perspective was recognizing that this isn't a one-size-fits-all decision. It's about building a strategy that works for your unique financial journey. The journey toward financial independence through ETF investing isn't about chasing the perfect ETF or trying to time the market just right. It's about creating a sound strategy that aligns with your goals, staying disciplined through the ups and downs, and allowing the power of compounding to do its work over the long term. Looking back on my own decision-making process, I feel confident that DGRO and HDV give me exactly the kind of foundation I was searching for. A balance of growth and stability that supports both long-term wealth building and dependable income generation. I don't see them as a get-rich-quick win or some shortcut to riches. Instead, I view them as a reliable, proven strategy to investing. Owning high-quality companies that reward their shareholders consistently, year after year. What really sets this strategy apart for me is the combination of capital appreciation and growing dividend income. By spreading my investment across a diversified portfolio of financially strong businesses, I've built not only resilience, but also peace of mind. Markets will rise and fall, that's inevitable. But knowing I own companies designed to steadily grow and return value keeps me anchored. At the end of the day, this isn't just about making money, it's about building freedom, security, and the kind of financial foundation that supports the life I want to live, both now and in the future. I'm glad you found this helpful. If you did, check out the playlist I've linked. It's packed with dividend investing strategies and ETF breakdowns that build on everything we just talked about. See you in the next one.